The vast majority of men who try their hand at the tape fail. Understand this fact now. They fail not because they lacked vision. They fail not because the market moves against their ideas. They fail because they lacked a war chest when the real opportunity finally arrived. They confuse trading with gambling. They mistake temporary excitement for lasting speculation. I have spent my entire life standing on the trading floor, observing the ruins of men who knew how to make a dollar but never understood how to keep one. I have seen the same error repeated in every boom and every panic. The error is simple. They forget their first duty. If you listen to the modern chatter, your first goal is always speed, always velocity, always the highest possible return. The gurus promise quick fortunes. If you listen to history, to the cold, stark reality of the ticker, your true first goal is ensuring you remain solvent to trade another day. Your primary function is survival. Survival is achieved through one absolute, non-negotiable principle. Never, under any circumstance, allow your core capital base, your principle, to be compromised. Never allow it to be significantly reduced. The quickest, most assured path to generating true generational wealth is the slow, disciplined, almost monotonous act of protecting what you already possess. Everything else, every fleeting gain, every celebrated paper profit, is a statistical vanity until that fundamental truth is internalized. It is fool's gold until you learn the art of defense. If you cannot defend your position, you will not profit from your offense. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The principle of protecting one's principle is often learned at the highest possible cost, the ultimate market penalty levied against the unprepared operator. Rather than submitting to this destructive assessment, we can access the definitive record of the man who paid it in full, Edwin Lefebvre. 1923 classic, Reminiscences of a Stock Operator. This text, built on the experiences of Python Jesse Livermore, serves as a profound psychological training ground, allowing the serious student to traverse the cycles of speculative greed and fear vicariously, absorbing decades of costly lessons without liquidating a single position. To ensure this critical wisdom, recorded during the era of Jesse Livermore, is fully contextualized and applied accurately to modern markets, the commentary provided in the Max Davidson Annotated edition is indispensable. A link to this essential edition is provided in the description below. Let us speak plainly about the rules that separate the survivors from the statistics. The non-negotiable core rule. The ultimate error is believing the game offers second chances once the marker has been wiped clean. It does not. The game ends the precise moment your principal reaches zero. It is not suspended. It is not paused for a recess. It is not waiting for a convenient infusion of outside money. It is over. When your account is exhausted, the market ceases to exist for you. It becomes an observer sport. You have converted yourself from a player into a spectator, forced to watch opportunities pass by while others profit. The mathematical difference between a significant loss and a total loss is vast, but the psychological difference is often negligible until it is too late. A 50% loss requires a 100% gain merely to return to the starting line. That is a Herculean task. It demands absolute perfection in your subsequent commitments. It demands a market movement of tremendous clarity and length. But a 100% loss requires an infinite gain just to continue trading. It requires a fresh infusion of capital, often capital you do not have, or capital that must be withdrawn from your life, from your savings, your home, your family's security. This distinction must dictate your strategy. Survival is not equal to profit. Survival is superior to profit. Survival is the precondition for profit. The speculator must internalize this hierarchy. The gambler plays for the score. The speculator plays to ensure he is around for the next hand, and the hand after that, and the market swing after the next panic. Never, under any circumstances, risk the ability to trade tomorrow for the thrill of a large profit today. Do not sacrifice liquidity for conviction. Do not sacrifice certainty for hope. Your core principle is your lifeblood. Once spilled, it cannot be easily returned. The first rule is simply, keep trading. And to keep trading, you must keep the powder dry. Risk management is a maximum cap, not a suggestion. If you lack a firm, unwavering policy on risk, you are not trading. You are merely hoping. A structured business defines its maximum liability before signing the contract. Why should speculation be any different? The market is the ultimate liability. You must define, in hard currency before you ever enter a position, the exact maximum dollar amount you are willing to lose. This is your insurance premium. This is the fee you pay the market for the clarity of its direction. This number, this precise measure of loss, must be fixed, and it must be low. It should never exceed a small fixed percentage of your total trading equity. For the seasoned operator, this cap might be 2 or 3%. For the newer man, I will permit 5%, but never beyond 10. 10% is already a dangerous gamble. Let us say your total trading capital is $50,000. 5% risk exposure is $2,500. That is the limit. That is the iron wall. If a stock moves against you and hits that predefined number, you exit. Immediately. Without question. Without debate. This percentage cap is not a suggestion offered to your emotions. It is the guardian of your principle. It is the sentinel standing watch over your future solvency. If you calculate a position and find that the necessary stop-loss level, the point at which your hypothesis is proven wrong, requires you to mentally cross that hard percentage line, then the trade is flawed. Perhaps the trade is too large for your capital base. Perhaps the conviction required is too shallow. Or perhaps the setup itself is simply too volatile for prudent engagement. The answer is not to widen the stop. The answer is to reduce the size of the position, or better yet, to walk away entirely. The speculator who protects his principal views every single trade not by its potential gain, but by its maximum potential loss. The risk must always be calculated first. The reward is a secondary calculation, only valid if the risk is acceptable to the continuation of the entire business. Do not be the man who risks 20% of his capital on a single coup. If that coup fails, he must now secure a 25% gain just to get back to zero, and the emotional burden of that task will cripple his ability to think clearly. Protect the principle. Define the line. Do not cross it. The power of the cash position. The greatest defense of principle is not the stop-loss order. It is the simple, honest recognition that sometimes the market offers no opportunity worthy of your valuable capital. Your principle is best protected when it is not actively exposed to market turbulence, to the daily ebb and flow, the manipulation, and the sudden, irrational shocks of news. Too many men who enter this game feel this compulsion, this internal anxiety, to be always active, to have capital deployed, to be constantly in the market. This urgency is the surest path to incremental erosion of capital. It is the way men lose fortunes through small, frequent losses in non-trending markets, or in markets that are merely chopping sideways. They enter trades for the sake of entering trades, sacrificing their cash position for the emotional thrill of action. Cash is not a passive position. Cash is not cowardly. Cash is the most powerful position a professional speculator can hold. It is a defensive fortress, complete with immense liquidity and mobility, waiting for the optimal siege conditions. When you hold cash, you are liquid. You are ready. You are positioned to take advantage of the fear and folly of others. The market only truly trends either up or down for perhaps 30% of the year. The remaining 70% is noise, consolidation, and distribution. To trade during the noise is to waste your principle. If I see no clear, definite direction, I sit on my hands. I wait. I preserve the cash. The patience to sit still, sometimes for weeks or even months, is the ultimate protector of liquidity. It ensures that when the clear signal finally sounds, I have the full buying power, the absolute conviction, and the necessary financial stability to commit serious money. Never underestimate the power of zero exposure when the environment is unclear. It is protection perfected. The margin trap is the ultimate principal killer. We must speak plainly about leverage. It is a tool of acceleration, and 9 times out of 10, it accelerates the speculator straight into insolvency. Do not leverage yourself into ruin. Margin allows a man to temporarily control a much larger position than his capital would otherwise permit. It allows you to accelerate your paper profits. This is the seductive side of the tool. The brutal reality is that margin exponentially accelerates your losses, turning what should have been manageable temporary drawdowns into forced liquidations, calls that strip you of control and dignity. When you speculate on margin, you are no longer trading with your money alone. You are trading with borrowed money. You have essentially taken a loan from your broker, and that broker is not your friend. When you use borrowed money, the time horizon for your operation is drastically shortened. The broker determines your capacity to hold the position, not you. This compression of time makes emotional decisions mandatory. The moment the market moves adversely, the margin clerk calls, demanding either more collateral or the closure of the position. You are cornered. You are forced to sell at the worst possible time because you lack the liquidity to weather the fluctuation. This is the ultimate compromise of principle. You are sacrificing control to chase extra percentage points. True protection of principle involves only risking capital you own outright, capital that, if lost, does not trigger a cascade of external demands and forced liquidation. If you must trade on margin, the position must be so conservative and the collateral so overwhelming that a 20 or 30% adverse move would still leave you comfortable. But if you are comfortable, why use the margin in the first place? The only purpose margin serves for the average man is to provide the illusion of power just before the reality of ruin sets in. Stay liquid. Stay unencumbered. Own what you speculate upon. The immediate nature of cutting loss, a small fee for clarity. The market will always teach you lessons. Your duty is to pay the smallest possible tuition fee. A loss is not a defeat. It must be treated coldly, logically, as a transaction fee paid to the market for providing clarity about its immediate direction. When you enter a trade based on a hypothesis, say, stock A will rise above 50, and the stock instead falls to 48, your hypothesis is wrong. Not temporarily wrong, not possibly wrong, it is demonstrably immediately wrong. The loss must be immediate, definitive, and relatively small. The danger to the core principle never comes from the first small loss. A 3 or 5% loss is an acceptable cost of doing business. It is a proof of concept fee. The catastrophic danger comes from the speculator's refusal to accept that small loss. The ego steps in. The emotional demand to be right overpowers the financial necessity of being solvent. He allows hope to seep into the trading equation. He thinks, it will come back. He holds the position, allowing the 5% mistake to fester into a 15% drawdown, and then perhaps a 30% disaster. At 30%, the principal is gravely wounded. The recovery is a 50% gain, which is now immensely difficult to achieve with damaged confidence and depleted capital. The first loss is the cheapest loss you will ever incur. Cut it clean. When a trade moves against you, you must feel the same dispassionate urgency as a surgeon recognizing a gangrenous limb. Cut it off immediately to save the body. The man who hesitates to exit a position because he fears realizing a small loss will inevitably be forced to realize a gigantic loss. He sacrifices the principle to preserve his pride. That is folly defined. Keep your losses trivial. Let your profits run until the trend ends. Never confuse the two. Test trades in confirming the environment. Before you commit the full weight of your principle, you must ensure the battlefield is precisely as you perceive it. You must conduct a reconnaissance operation. Never ever commit substantial capital to a market without first establishing a small, almost insignificant test position. This small trade is not designed to generate immediate profit. It is purely an experiment. It is a probe. Its function is to test the waters, confirm the market's behavior, and ensure your entry timing is aligned with the current flow of least resistance. If I am looking at a stock that appears ready to break upward, I do not buy 10,000 shares immediately. I buy 1,000. That small initial purchase is my scout. If the market is genuinely ready to move, that 1,000 shares should immediately show a small profit. It should confirm the analysis. It should move swiftly in the anticipated direction. If the test trade confirms the movement, then, and only then, do you scale in with the bulk of your capital. You increase the position size progressively, confirming the safety of each step before taking the next, thereby minimizing the exposure of your principal during the uncertain entry phase. But what if the test trade fails? If the 1,000 shares immediately decline, or if the stock stalls, or if the movement is hesitant, the market is sending you a clear signal. Wait. Your timing is off. The moment is not yet here. If it fails, you've lost a minimal sum. You paid the small tuition fee. The bulk of your capital, your principal, remains untouched, preserved for the next clearer setup. This method prevents the speculator from committing 20% of his cash into a premature or false movement. It ensures that large commitments are only made into positions that are already proving correct. Preserve the capital by risking only a fraction to gain the necessary intelligence. Risk small to gain clarity. Commit large only when clarity is absolute. Avoiding the consolidation grind. Your principal is not merely protected by avoiding catastrophes. It is also protected by avoiding the slow, debilitating erosion of meaningless activity. Markets, being human affairs, spend significant time doing nothing decisive. They move sideways. They are consolidating. They are pausing between major moves, absorbing information, and preparing for the next thrust. Trading during these sideways periods is often a pure zero-sum game. You buy low, the stock dips lower. You sell high, it ticks marginally higher. The only guaranteed beneficiary of this ceaseless activity is the brokerage house, collecting commissions on both sides of the movement. Protection of principal requires the mature recognition of these periods. When the market lacks a clear, powerful direction, when it is simply chopping, your principal is best served by being withdrawn from the fray. The temptation is immense. The mind sees the price moving from 70 to 73 and back down to 70 and believes mistakenly that money can be easily made by picking the tops and bottoms within this tight range. This is a speculator's grave mistake. The tight sideways movement invariably leads to whipsaw losses. You buy the bottom, it falls through support. You short the top, it breaks resistance briefly before falling back down. You lose money on volatility, on transaction costs, and on indecision. This activity is not speculative. It is merely gambling on noise. By preserving your buying power during the consolidation grind, you protect the liquidity required for the eventual breakout. When the clear trend finally emerges, you have the full force of your principal ready to commit, unburdened by the small, frustrating losses accumulated during the sideways movement. Patience is the currency of the successful speculator. Deploy your capital only when the market itself is offering a clean, unobstructed path. If the path is muddy, wait on the shore. Position sizing as the ultimate hedge. Many men believe that diversification is the protector of principal. They spread their capital across dozens of stocks, hoping that if one fails, another will rise. I tell you this: true, meaningful wealth is rarely built through diversification. It is built through concentration on confirmed, clear opportunities. However, concentration is only safe if it is managed by stringent position sizing. Position sizing is the real protector of your principal. It is the mathematical mechanism that allows you to express massive conviction without inviting total ruin. If I have overwhelming conviction in a particular stock, if I have studied the tape, confirmed the environment, and believe with certainty that this is the beginning of a major move, my overall risk exposure must still be respected. The 5 to 10% total risk limit is still paramount. This means that even your best, most confident trade cannot consume an undue portion of your trading capital. Let us consider two men. The first man allocates 25% of his capital to a stock he feels is good, but he ignores the stop-loss level. The stock drops 20%. He has lost 5% of his total principal immediately. The second man allocates 10% of his capital to a stock he believes is brilliant. He respects a 10% stop. If the stock hits the stop, he has lost 1% of his total principal. The man who risks 1% has retained 99% of his financial capacity. The man who risked 5% has already begun the treacherous path of serious recovery. A small allocation in a brilliant stock is always safer, always more prudent than an oversized allocation in a merely good one. The temptation is to leverage the conviction. The discipline is to temper that conviction with mathematical reality. You must size your position not based on how much you want to make, but on how much you can comfortably lose if the universe proves you wrong. Position sizing is the wall that ensures one bad bet does not undo 1,000 good decisions. Keep the allocation small relative to the principal, and your risk becomes manageable. The fatal logic of averaging down. There is perhaps no greater financial crime against one's own principle than the habit of averaging down. Averaging down is not a strategy. It is the emotional impulse to protect the ego at the expense of the balance sheet. It is the definition of financial cowardice combined with intellectual stubbornness. It is the act of doubling your bet or tripling it on an already proven wrong hypothesis. When a stock moves against you and you decide to buy more at a lower price, your stated intention is to lower the average cost of the total position, thereby making recovery easier. The actual effect is that you dramatically increase your exposure to a deteriorating situation. You are increasing the total risk exposure to a position that has already demonstrated its weakness. You are pouring good money after bad money. Imagine a hole in the ship. The disciplined man seals the hole and takes the small penalty of the water already shipped. The fool, however, deciding he has too much invested in the water already inside, deliberately opens another hole to equalize the pressure. Every time you buy more of a losing position, you accelerate the erosion of the core capital that must survive. You increase the margin of loss exponentially. The rationale is always, it's cheaper now, forgetting that the market is telling you exactly why it is cheaper, because the consensus is selling and the underlying trend is negative. The successful speculator doubles his bet on his successes. When a stock is moving in the desired direction, when the trend confirms the initial analysis, that is the time to increase the allocation. Averaging up is disciplined. Averaging down is suicidal. Once a predefined stop loss is hit, the trade is finished. It is dead. It is not redeemable. Do not try to resurrect a losing position by throwing more of your precious principal at it. Walk away clean. The mathematical reality of recovery. If all the psychological and emotional arguments fail to convince you, then let us rely purely on the cold, unforgiving mathematics of the situation. You must understand the devastating effect of drawdown on the principal. It is not linear. It is exponential. The percentages required for recovery quickly become Herculean, exhausting your capacity and your patience. Consider the steps. To recover from a 10% loss requires an 11.1% gain. Manageable. A quick rebound. To recover from a 20% loss requires a 25% gain. Serious effort is required. To recover from a 25% loss requires a 33% gain. This is demanding. To recover from a 33% loss requires a 50% gain. Now the pressure is immense. To recover from a 50% loss requires a 100% gain. You must double your money merely to return to where you started. Imagine the man who loses 80% of his principal. To return to the starting line, he must secure a 400% gain. This is often an impossible task without several years of exceptional market movement or adopting reckless gambling strategies. Each percentage point lost to negligence or ego increases the hurdle exponentially. This stark, undeniable mathematical reality must serve as the emotional and logical barrier against undue risk. The man who allows his principal to suffer a 50% reduction must now trade perfectly just to get back to zero, and he must do so with half the capital he started with. This reduces the size of his potential profits even if he is suddenly correct on every subsequent trade. He is wounded and slower. Protecting the principal saves you the Herculean effort of unnecessary recovery. It saves you years of grinding effort. It allows you to focus on capitalizing on new opportunities, rather than merely attempting to restore past dignity. The single greatest competitive advantage you can grant yourself in the speculative arena is to maintain a high percentage of your original capital. Always ready, always liquid. Do not burden your future self with the weight of massive drawdowns. The markets are cyclical. They move through booms and through panics with absolute regularity. Fortune does not favor the aggressive gambler. Fortune favors the prepared, the patient, and the solvent man. Generational wealth is not created by chasing every fleeting headline, every rumor, or every margin call that promises a quick score. It is created by ensuring you are liquid, that you are solvent, and that you are ready to deploy massive, concentrated capital during the 3 or 4 true, undeniable opportunities that appear in any given decade. The man who risks 10% of his capital on every trade will be financially crippled or entirely wiped out before the true panic arrives. The disciplined man, conserving his principal, will be the one buying the fortunes at basement prices from the man who was wiped out. Discipline is not a restriction upon your earning potential. It is your ultimate leverage. If you protect your principal and if you commit only when the tape confirms your thinking, then time, the passage of market cycles, will guarantee your success. The most important trade you will ever make is the trade you don't make when the conditions are unclear, when the risk is unquantifiable, or when your capital is already overexposed. Preserve the ammunition, survive the day. The opportunity will always return for the solvent man.